This is Robert Kraft, and I'm your host on SNN Network, and we're at the Sprott Natural Resource Symposium 2019 in Vancouver. With me right now is Adrian Day from Adrian Day Asset Management. He is a speaker here at the event. Adrian, welcome to this Wall Street View.
Thank you for having me.
It's great to have you on as always. So for those who don't know, let's get your background first, and then we'll go into some of the topics that you're speaking about here.
Well, I'm from London, as you may be able to tell, but I have a money management firm. We invest money primarily in global equities as well as resources for retail investors.
So you're a speaker here at this event. What's your topic for this year's symposium?
Well, I'm talking about easy money, the Federal Reserve, other central banks, and easy money policies and where they could lead us.
So what's your thesis? Let's do it.
Well, the thesis is that governments have been destroying the purchasing value of their currency throughout the centuries, throughout the millennia, from clipping coins and mixing base metals with gold and silver coins to Keynesianism and easy money and QE and all the other things that have come up since the credit crisis. But they're all at their heart, they're all variations of the same thing, which is easy money. Easy money means implicitly the destruction or the destroying the purchasing power of money, which means hurting savers and therefore limiting the amount of money that's available for capital investment. Those are obviously negative things. And we've reached, since 2008 in particular, with the quadrupling of the size of the Federal Reserve's balance sheet and interest rates going to almost zero in the US and negative in much of the world, we've really reached, I think we're reaching a conclusion of this. Now we have this modern monetary theory, which I call magical mystery twaddle, which really is the sort of conclusion, if you like, or the denouement of easy money.
So I'm guessing that the reason that this is your topic for this event, we're at a resource conference, is your thesis then is it that because of these things, resources might be where you want to participate as an investor?
Absolutely. And what's key to what's happened, in the last 6 months is that the central banks of the world, the major central banks of the world, the Federal Reserve, the European Central Bank, the Japanese National Bank of Japan, and others, all said QE is over and we're now going to start tightening. We're going to start raising interest rates. We're going to start reducing the size of our balance sheet. The Federal Reserve, to its credit, but only to its credit compared with the other central banks around the world, actually did start raising rates and did start actually reducing the size of its balance sheet. Marginally, when you look at the size of a previous increase, but they did. Japan and Europe didn't raise interest rates, didn't sell a single bond, or didn't net sell a single bond. And already, central banks around the world have said, tightening's over. That is exceptionally bullish for gold, because what it means, in my view, what it means is that central banks have wanted to tighten, have looked at the situation, and either cannot do it or are afraid to do it for fear of the consequences. When they started raising rates back in the fall last year, the U.S. market and other global other stock markets around the world started falling significantly, and the central bank, who in my view shouldn't really be concerned about financial assets, they shouldn't be concerned whether stocks are going up or down. They blinked and they said we can't do this. So we are now on a treadmill, if you like, of perpetual easy money, and you can't have a little bit of easy money, and you can't have just 2% inflation. You can't have stable inflation at 2%. It doesn't work that way. So inflation is likely to get higher. And the other thing I would say, Janet Yellen, the former central bank head in the US, and other central banks around the world want 2% inflation. And they say 2% inflation is a stable rate. It's not stable. If you've had 2% a year, that means you lose over a third of your purchasing power in 20 years. over a lifetime, that means what at the beginning of my life or when I'm a teenager I could buy a suit, a good suit with. When I'm 70 years old, I can barely buy a cheap shirt. That is destruction of purchasing power. That is not stable by any means. And let's forget about the fact that we're unlikely to stick at 2%. These things have consequences. And I don't know how much time we've got here, but these things have consequences. And one of the things I'm talking about in my speech is when you take easy money too far and you destroy the purchasing power of money and therefore people's savings too rapidly, it leads to violence and tyranny and ultimately often war. And you think of Zimbabwe and you think of Argentina, which destroyed the purchasing power for so many years, and they had the junta and that disappeared, and the war in the Falkland Islands, which was just to take people's minds off what was happening at home. And that's often what wars are for, right? To take people's minds off what's happening at home. And it's interesting because Ray Dalio, who is a obviously very smart hedge fund manager, recently turned very bullish on gold. He did a paper on MMT, modern monetary theory, and he said we shouldn't be too concerned about this. First of all, it's inevitable, and we shouldn't be too concerned because it's been tried, it's been put into practice many, many times in history before. And he gave 12 examples. And of those 12 examples, 9 of them ended in war. So you have, the destruction of a currency under Rome. There were many reasons, of course, why the Roman Empire fell, but the destruction of a currency was one of them. You have the German hyperinflation in the 20s, which led to the rise of Hitler in the Second World War. You have the destruction of a currency under the early Stuart kings, which led to the English Civil War. You have the destruction of a currency under the Jin dynasty in China in the 13th century, which led to the invasion of the Mongol Empire. Of the Mongols that became the Mongol Empire and destroyed the Jin dynasty, and so on and so forth. So destroying the purchasing power of a currency, in my view, is a very, very serious and potentially very destructive thing to do.
So then looking at the near term, let's say for the next 6 months,
Okay.
right? Because, who knows how long some of those things might we might see the effects of, right? So let's say in the near term, what are some of the catalysts or things that you're looking out for that our investors should also be aware of?
I think the most important thing for investors in the sector to understand is that sentiment has changed. Now, when the sentiment has changed, it doesn't necessarily mean, of course it doesn't, that gold and silver are going to continue going up, in a straight line. Of course not. What it does mean, though, is that if the sentiment is positive in a bull market, gold can react positively to positive developments and brush off negative developments, just as when it's bearish, every little bearish thing becomes a major catastrophe and the market ignores bullish developments. So we have now changed and sentiment has turned to positive. I think next week, or this week actually, this coming week with the Federal Reserve meeting, I think we could see a sell-off in gold, frankly, because the expectations are so high that the Federal Reserve, in my view, is not going. It's very unlikely that we will get a positive surprise. They might do what we're expecting, that's already in the price, or they might disappoint with some of their commentary, but they're not going to pleasantly surprise us. So we could see a bit of a sell-off. But I think that will only be short-term and temporary. The key is sentiment has changed. So as we see easy money policies pursued in Europe, remember Draghi at his press conference last week when he's resigning said that the outlook in Europe is worse and worse. This is after 10 years of easy money. Who is responsible for the outlook being worse and worse? It's the people who control the monetary policy. And yet their answer is always to do more of the same. Damn it, the patient didn't get well when we gave him, 5 milligrams of morphine. Let's double it and give him 10, see if that does any better. And that's really what they're doing. They're just doubling down on failed policies. So anyway, sorry, you asked me in the short term. I get excited about this. I get excited about this because, to be honest, there are so many intelligent people looking at this who can see what is wrong, and I'm not talking about myself, I'm talking about other people, and yet the central bankers simply can't see what they're doing. And it's preposterous for someone like Draghi to say after 10 years of easy money, things are getting worse and worse, we need to do more of it. So I think in the next 6 months we're going to see much higher prices for gold, potentially for silver as well. Silver, of course, can respond much more to changes in demand because the changes in supply don't come so quickly for silver as they do for gold. So a change in demand for silver sees much higher prices or lower prices, depending on how the demand changes, in the nearer term. So I think the things to look at are really the main thing to look at is monetary policy around the world, frankly, from Europe, Japan, and U.S. as well as China. And we haven't talked about China, but China's pursuing easy money policies, but they're pursuing targeted easy money, which is a little bit different and frankly maybe a little bit better. They're targeting certain sectors that are getting particularly weak. But look for easy money policies around the world. And then the other things to look for are obviously, the trade. If there's a settlement in the trade dispute between the U.S. and China, people think that would hurt gold. It would probably see a sell-off in gold in the immediate term. But frankly, better trade and a better economy is good for gold. That's not what we need to be afraid of if we're gold investors. So we might see a bit of a sell-off, but then it would come back. That's obviously another thing to look for. If there's moves towards impeachment of Trump, I think that boat has sailed, frankly. But that would be positive for gold because it would be negative for the dollar. And then also the thing we need to look for as we get into next year, this is more than 6 months, but as we start getting towards the end of this year then, towards the end of your 6-month period, we need to start looking at the Democratic candidates for president of the U.S., who are the front runners, and then we need to start to really focus in on the policies of those front runners. The market hasn't done that yet for two reasons. One is it's a year and a half away, so, that's an eternity in the market. But secondly, there's 20 of them talking on stage every 2 weeks, so you don't really focus. Once we narrow it down to 2 or 3 front runners, the market will start to look at some of the policies. And depending on who it is, obviously, some of those policies are pretty dangerous. Sorry, no, go on.
No, I was going to say, is there one more point that you wanted to make?
I was just going to say a recent survey showed over 40% of Democratic voters say we need a fundamental change in the way the U.S. economy is organized. I don't know if they know what they're talking about, what they mean, but that's pretty significant, in my view.
So where can our audience go and find more information about Adrian Day at Adrian Day Asset Management?
Yeah, it's www.adriandayassetmanagement.com.
My name is Robert Kraft, and I'm your host on SNN Network, and we're at the Sprott Natural Resource Symposium 2019 in Vancouver. With me again has been the passionate Adrian Day from Adrian Day Asset Management. He's the speaker here at the conference. Adrian, it's always a pleasure. Thank you.
Thank you so much. I appreciate it. Thank you.